Good morning, ladies and gentlemen. I know everybody's been talking about this program, and I'd love to take a minute here and really break it down for you because, as the phrase goes, the devil is in the details. My personal opinion, I was reserving it up until this week when CalHFA came out with the actual guidelines. And God's honest truth, I think it's a winner. But it's important to know the exit strategy to this product. So if you're a first-time buyer, and obviously saving up money is getting a little bit harder nowadays, especially with inflation. This program will give you up to 20% for your down payment. So it's going to be a great alternative to all the other down payment assistance programs out there. And you have to know that funds will run out. Okay, so no scare tactics, no FOMO, nothing like that. But you do have to definitely move forward on this product and look for a new home if you want to take advantage of it. If you couple that with the home inventory being historically low, it's not going to help the situation. So the sooner you can get to moving, get fully pre-approved, get educated. If your lender is not giving you a full 30, 45-minute Zoom consultation, breaking it down, being transparent, and you feel like you just don't have all the pieces fitting together, give me a call. I'm here to make sense of it all, but really give you a transparent, no BS educational process. So let's go through it here. This program, the Dream for All, is a loan program for first-time home buyers only. So you couldn't have owned a home in the last 3 years. The money that they give you, they call it a silent second. So if you look on your title report when you buy that home, just like when you buy a used Carfax report, you'll have your first mortgage that you're paying on, and you'll see that 20% that they give you as a lien behind it. You do not have to make monthly payments on it. It is at zero interest, so it's not going to accrue and grow over time. And the funds, as I mentioned, can be used towards the down payment and closing costs. So if you're like, this is finally a great alternative for people that, hey, I got two to 3,000. I have enough for the appraisal and the home inspection, which usually runs about $900 to $1,200, just to give you a price range that you have to pay for before closing, but you need the remainder of the closing costs covered. And if the seller's not going to credit that to you with all the other programs out there, you're about 5 to 10,000 out of pocket right now with all other down payment assistance programs. So what we're doing is we're stacking these loans where instead of putting the full 20 towards the down payment, we do 17 or 18% or even 16%, and we use the remainder of that money and cover all of your closing costs. I got one client coming in with about 2,000, another wants to come in with 5, and another wants to come in with 10. So they can be closer to that 20% down. And I also have another client that said, hey, I'll pay the total, all the closing costs, and let's do the full 20%. Because when you do 20% down in total, you have no mortgage insurance. So great alternative. You can move the numbers around to fit what you need as far as closing cost assistance as well. Conventional financing only. Okay, no FHA, no VA. As I mentioned, all borrowers must be first-time buyers. It's for primary residence only, and a staple of the CalHFA products. They always they limit you. You can't have non-occupying co-signers. So everybody on that loan has to have the right FICO scores, and they must be moving into that home as their primary residence. You must be a U.S. citizen in the eyes of financing. Permanent, non-permanent resident aliens are just fine as well. You have to take an 8-hour online buyer's course. Don't worry about that. Don't do it up front. You can do it once your loan's approved. It's pretty simple, and it usually ends up only being a couple hours. Costs $99, and we can give you the link once your loan's approved. So the type of properties that they will allow: single family home, condominiums, and manufactured homes on permanent foundations, not mobile homes. Those are under the Department of Motor Vehicles on land leases. So CalHFA will use the lender's income calculation to qualify, which is nice because they say, all right, if you had a couple big years and this year it's down a little bit, but if you add up your previous years, you're over the income limit where you're shot out. Now we can use the CalHFA will follow the lender's qualifying calculations. So if you're right there on the line here with these income limits, then maybe we can squeeze you just underneath, which is a nice little blessing there. So let's take a look at those income limits here. So they're pretty generous. Orange County, 235,000. Riverside, 173,000. Same thing for San Bernardino, 173,000 there. San Diego, 211. Fresno, 159. So with all these programs, the ones that do have income limits and limitations, this one is probably one of the most generous ones by far as well. So again, great product. I'm really standing behind this one. Um, so credit score requirements, okay, it is conventional, and they are giving you probably the most money than we've seen in all other programs. So 680 plus FICO. This goes for every borrower on the loan. Everybody has to have a 680 middle credit score. So in the lending world, we throw out your highest score, we throw out your lowest score, and we got to go off your middle FICO score. 680 will let you go up to a debt to income of 45%. 700 plus credit scores for all borrowers, you can go up to 49.99%, assuming Fannie Mae approves you up at that range. So very nice credit requirements there. One of the big things I was reserving my opinion on, being that we're in a higher interest rate market, which I mean, that's subjective. When I got in, it was 9.5% on the rates. However, CalHFA will allow you to refinance one time. So probably this time next year, sometime towards next year, asterisk mark, only the good Lord knows. But we do know rates are going to be coming down, and they will allow you to refinance one time, and they will what they call resubordinate that loan. So you can refinance the first, and they will go back in the second position on the money that they give you. As far as the payments, as I mentioned in the beginning, the payments are deferred for the life of that first loan. So if you buy that home, you don't ever refinance, you run it out the full 30 years, the money that they give you will be required upon paying off that 30-year fixed mortgage, which odds of that happening are slim to none, if we're being honest. It will become due and payable if you transfer the title to a family member or a friend, you sell the home, or you pay off the first in completion, or you have a notice of default. And this is not an assumable loan as well. So the shared appreciation part. So, this is not a quick turn and burn product. You should expect to be in this home at least 5 years so you can gain enough appreciation and pay down the principal balance of that new loan that you take on, so you can walk away with a little bit of money. This is not going to be a money maker for first time buyers. That's not a bad thing. It is what it is. So you can plan accordingly, and hopefully in 5 to 7 years, as we all get older, we make a little bit more money, and we have a little bit more stability in our lives there, if that's where we're at in the point in time. So upon sale of the home, you have to obviously pay back that first 20% that they gave you. Let's call it $100,000, and you bought a $500,000 home. So they give you 100 grand. You got to pay that back come hell or high water. And then CalHFA will take 20% of the shared appreciation. So in this chart here, excuse me, you bought it for 500,000. You sell it for 640,000. The gross appreciation is this 140,000. So you would be sharing the piece with CalHFA as well as paying that back. So 5 to 7, even 10 years down the line, if you hold that mortgage, you're probably going to walk away with a decent amount of equity that you can use to now lily pad and buy up on a bigger home, or buy down whatever life brings your way. So in here, we have a bunch of questions as well. I'll just go through a couple of them, but if you would like a copy of this slide, feel free to reach out to me at any time. It's for everywhere in California. There's no certain specific areas, as long as you follow the income limits per the county, you have the proper FICO scores, and you qualify. You do not have to make monthly payments on that shared appreciation loan and the down payment piece that they give you. Okay. In My Home Assist, so you cannot combine this with any other CalHFA down payment assistance, but that's okay. Kind of like I mentioned, we can stagger that 20% down, use 15, 16, 17% for the down, and the remainder of that funds we can use to cover your closing costs. So in this slide, it has a bunch of different questions. Again, I do believe this is God's honest truth. The way I've been penciling out every which way from Sunday, I think this is a very, very good product. Again, please don't sleep on it, because when they run out of funds, they run out of funds, and then it's going to take probably 3, 5, 7 years before those funds start to cycle back through, with all the people utilizing it today, selling their home and moving on. So it replenishes that account there. I know it's not the prettiest thing in the world, but you can trust the beard. God bless you. Let me know if you have any questions. Hope you have a wonderful day, and looking forward to speaking soon.